Why bond prices go down when interest rates rise, understanding bond calculations. Bonds are often considered a safer investment than stocks, but their pricing can be tricky to understand. When interest rates rise, bond prices tend to fall. Conversely, when rates drop, bond prices rise. This inverse relationship can be confusing at first glance, but it's important to understand for anyone investing in bonds. Unlike stocks, bonds are loans made by investors to companies or government agencies. In exchange, investors receive fixed-rate interest income, usually twice a year. Bonds compete against each other on interest rates to attract investors. When interest rates go up, new bonds with higher rates become more attractive to investors. When rates go down, older bonds with lower rates become less attractive. Unfortunately, older bonds can't increase their interest rates to compete with new bonds. As a result, their prices must drop to remain competitive, which decreases the value of the original bondholder's investment. For example, let's say you purchased a bond with a par value of $1,000 that matures in 10 years and has a 3% coupon rate. 1 year later, the market interest rate increases to 4% and you want to sell your bond. A new bond with the same par value would now have a higher interest rate and therefore pay more in interest income than your bond. To make your bond more attractive to buyers, you would need to sell it at a discount, which would be determined by several factors, including the current interest rates, the number of coupon payments remaining, and the bond's face value. Understanding how bond prices are calculated can help you make informed investment decisions and achieve a diversified portfolio with both stocks and bonds. The discount rate. The discount rate is the amount by which the original bond price is reduced to sell it at a particular point in time. It's expressed as a percentage and depends on the bond's maturity, interest rate, and other factors. In general, if you're looking to sell a bond in a rising interest rate environment, you can expect to receive less than the bond's face value. The longer the bond's maturity, the more it will fall in value. Additionally, the lower the interest rate on the bond, the more it will fall in value when rates rise. If you're investing in bonds, it's important to understand the relationship between bond prices and interest rates. When interest rates rise, bond prices generally fall, and when interest rates fall, bond prices generally rise. Bondholders who want to sell their bonds in a rising interest rate environment may need to accept a lower price than they originally paid. However, it's important to remember that bonds still have a place in a diversified portfolio. They provide income, capital preservation, and can reduce overall portfolio risk. As with any investment, it's important to do your research and understand the risks and potential rewards before investing.